Good morning. We have a full house today, right, Ashley? Let me go ahead and let some folks into the Zoom room. We will go live here in just a minute. It's funny, every time I do this, I have to remember how I did it. I'm just trying to open Zoom and display it. This is eCam. I wish I had a technical assistant at times like this. There we go. It worked. I think it worked. Okay, I need a sound check. Oh, I better let some people in. Can you see me letting them in? Yeah. You can actually see who's there. Hey, good morning. If you're coming online at Zoom, welcome. Welcome if you're coming online on the YouTube or Facebook as well. We are live. We should be live. If you're on Zoom, joining us on Zoom, please let me know you can hear me. Anyone? Awesome. Thank you. Appreciate it. So before we totally get started, I'm going to check the chat box to see if we have any questions. Now's a good time to ask a question if you have a question. We're going to talk about investing today. Investment strategies are on the agenda. I'm going to cover 4 investment strategies today. I think I might try to review the perfect investment as well. We talked about that last week. Hey, good morning. Come on in. So we'll give everybody a few minutes to get logged into Zoom or logged into the classroom. And then we will jump right in. I've got a ton of information to cover. I won't cover it all today, but we will talk about investment strategies. I think I've mentioned several times that this is the most popular topic in the course. So I think the truth is, for about half the students in the course, it's the most popular topic, and for the other half, they're not that interested. Like my wife is not that interested in investing. So we have a question, Charles. How come assignments on Blackboard is always posted later rather than sooner? That's a good question. I post them after I do the lesson. So that's actually, I guess, how do you normally get them posted, Charles? Do you get all of your assignments up front? Tell me more. I'm not sure that's the reason, because I teach the lesson and then I assign, I do the homework assignment. And sometimes those assignments change. They change every semester for sure. So sometimes they change as a result of the questions and the content for the week. But anyway, let me know. I'm looking for your comments. I don't see anything. If you want to speak, I could hear you too. Good question, I guess. I'm not exactly sure what you want. So let me know. Let's see. It's 10:04. Give me another minute. I'll take a drink of water and we'll get started. Any other questions? Post them now, or if you would, just wait until we get to the end of the lecture and then answer any questions. And I will try to pause for questions along the way. So, okay. Here we go. Righty. I'm going to close the chat window. I need to admit some more students. I think we have just admitted. It's 10:04. Going once, going twice. I don't see anyone else waiting to be admitted. Okay, let's get started. It's 10:05, so I'm going to close the admit button. If you haven't joined the Zoom meeting, then you're going to need to check it out on Facebook or the YouTube. So today we're going to talk about investing. investment management, investment strategies, really. And what I want to do in this lesson, what I want to do for the next couple of weeks is teach you about investing. And so to do that, I'm going to teach you some very common, well-known investment strategies. These strategies, there are lots and lots of investment strategies out there. So you're getting today, you're going to get introduced to 4 investment strategies that are really specifically designed to help you. And when I say you, I'm talking to students at the University of Houston in personal finance, knowing that there's a few of you that are older than others, but for the most part, I'm talking to you, students who are a certain age group, like under 30 years old, some much younger than 30. So the reason that matters is because these specific investment strategies that I'm going to be teaching you, they're designed to help you maximize returns and minimize risk over time. So the reason that's kind of important, it's important for me to make sure I communicate clearly that there are lots of investment strategies. If you're my age, I'm 59, I'll be 60 years old next month. Coming up, man, next month is coming quick. So if you're my age and you've spent your whole career investing and saving, the investment strategies that I would tell you about if you were me, if you were my age, if you were older, those would be different investment strategies. There's a whole bunch of investment strategies that work, but they work in different ways for different time horizons. So I just want to make that clear that what you're getting are 4 investment strategies that are very, in fact, 5 when we include the perfect investment. Do you remember the perfect investment? So we talked about that last week, the perfect investment. I'm going to try to highlight that today, but 4 investment strategies designed to help you maximize returns and minimize risk. So let me tell you what they are before I jump into them. The first one is diversification. So I'm going to talk to you about diversification and what that is and how it works. And I'm going to tell you a story about Enron. Diversification is very simple. It's the most common investment strategy there is, really. Diversification. So we're going to talk about that. And it's really just designed to help you minimize risk. The next one is asset allocation. Asset allocation is an investment strategy that is hands down the most important investment strategy, not just for your age, but for everyone, for any investor. And asset allocation is the single most important determinant of your portfolio's returns. So I want to make sure you understand asset allocation. So we're going to do that. You're going to walk out of the classroom today knowing these 4 investment strategies. So the third investment strategy is what I consider to be the most powerful investment strategy for building wealth for young people. It's called dollar cost averaging. And again, these investment strategies are very common. You could Google them, you could read about them, and that'd be a good thing for you to do. But today I'm going to tell you some stories and help you really apply how each of these strategies work. The fourth investment strategy that's designed to help you maximize returns and minimize risk is called portfolio rebalancing. And so I'm going to teach you these 4 strategies today, and I'm going to teach them to you in a way that will help you really understand these 4 investment strategies and how you can put them to work in your investment plan the day that you start working, and maybe even sooner if you have money to invest. But for most of you, when you start working, you're going to start having some money. Hopefully, that's the hope. That's the goal. And at that point, you're going to want to start investing, because the sooner you start, the more wealth you're going to grow. So last week I introduced the perfect investment, and I had to give the caveat, the warning, the disclosure, the legal notice that there is no such thing as a perfect investment. But if there was, it would be the match that you get in your 401k. So if you go to work with a company and they offer a match, we use the example of Shell. You go to work for Shell and they have an 8% match. And the scenario that I laid out was that you made $100,000 a year and Shell matched 8%. So if day one, which is what I hope you're ready to do on day one when you start working your job, you already knew that yes, you were going to sign up for the 401k plan. Yes, that's yes. And you were smart enough to know that this company that you were going to work for has a 401k match. So since you were smart enough to know that, you were also smart enough to know how much they were going to match, because that's the number you absolutely want to use when you sign that form with HR saying, A, yes, I want to participate in this 401k because it is a benefit. It's a benefit. And two, I want to take full advantage of the company match, which in this case is how much? 8%. So what is 8% of $100,000? It's $8,000, $8,000. So by saying yes, you're saying I'm going to put $8,000 this first year into my 401k account. And what is the company going to do when you do that? They're going to match it dollar for dollar up to 8% of your income. And that's why you wanted to put 8% of your income into this 401k, because you wanted the match, because that is the perfect investment. You put in $8,000, they put in $8,000, and what's the total at the end of the year in your account? $16,000. So we talked about one of the baby steps, one of the 7 baby steps that Dave Ramsey taught us, which is to save 15% for retirement. And so in that one perfect investment, you pretty much are able to kind of sort of check that off your list. Now, there's more that you're going to want to do, and you'll learn about those additional things you might want to do next week and the week after. But for now, I just want to make sure you understand that this one perfect investment, it's investing. And you're investing in a type of account called a 401k. Now, I'm assuming everybody goes to work for Shell, which is a corporation, and their retirement plan, the way that it's set up for a corporation, a for-profit corporation, is a 401k. That's the paragraph number in the IRS code that sets out the rules, boundaries, and limitations related to that type of account. So you're going to learn more about types of accounts in the coming weeks. But as we get into investing and investment strategies, I want to set the table and help you understand that the second law of personal finance is the law of tax-advantaged investing. And the IRS makes the rules, but your job is to take advantage of those rules. And one of the ways you do that is through this perfect investment. There are other ways that you do that as well, but when you're taking advantage of the IRS rules, what you're doing is you're taking advantage of certain types of accounts. So when we talk about investing, a lot of people get confused when I say, and this is on your quiz, so hello, this is on your quiz, types of accounts, types of investments. So we're going to talk about that today. But a 401k is a type of account. It's not technically an investment. What you invest in inside of your 401k, that would be an investment. And so I need to teach you a little bit about types of investments. And to do that, I have to teach you about something called asset classes. So I'm going to do that for a few minutes before I jump into the 4 investment strategies, because when we get into the strategies, they won't make a whole lot of sense if you don't understand a few basic things about investing in terms of, like I already said, types of accounts and also asset classes. So to do that, let me see what we have here. We've got somewhere 5 investment vehicles. Let me see if I can open that up. So in this, and all of this information is in Money Study Group. So I posted way too much information this week for you in Money Study Group. And you do not have to study it and learn it and master it. It's there for your reference, because I'm going to talk a lot today, and I'm going to say some things that you may want to go back and just kind of review. And so it's all just there for you to review. Trust me, this week's assignment is going to build on today's lecture. It's going to build on investing and investing strategies. But I'm not trying to make you an expert, just like I did not try to make you an expert in insurance. And then you went and did that auto quote, and that was something that was helpful, I hope. But this week in the assignment, you're going to calculate the cost of retirement. And so when you do that in your financial planning portal, you're going to have to say, you'll see in the assignment, I'm going to set you up as if you've already been working for a while and you're building some assets into your financial plan, like your 401k. So you're going to build a plan, you're going to calculate the cost of retirement, and you're going to get to see in your plan what that looks like over time. So what we talk about today will be helpful in the homework assignment, but you don't need to go deep and learn everything that I'm talking about today. I don't want you to be overwhelmed when you look and see what kind of goodies you have in Money Study Group, because there's a lot of information. So one of the things I wanted to just talk about is 5 types of investment vehicles. And I'm not going to go through all of them right now. I'm just going to mention them. If you want to understand them more, I would encourage you to go read the article that I posted in Money Study Group. It's called 5 Investment Vehicles. So I'm going to talk about types of accounts. I'm going to talk about types of investments, investment vehicles, and then I'm going to talk about asset classes. So each of those 3 things are different, and I just don't want you to be confused. So I want to spend a few minutes just going over definitions. So, and it is on the quiz, when I say this is a type of investment, and then I list Roth IRA, is that a type of investment? No, a Roth IRA is not an investment. It's not everybody, but a lot of people think, oh, I have an investment, I have a Roth IRA. No, that's a type of account. Just like your 401k isn't an investment, it's a type of account. So I want you to be smart enough to distinguish in those terms and understand when we talk about investing, we have to distinguish types of accounts if we want to take advantage of that second law of personal finance, which is really powerful, called tax advantaged investing. It's all about the types of accounts. And then inside of those accounts, we have certain types of investments. And the investments come in all kinds of shapes and sizes. And so as we talk about investments, one thing we have to talk about is an investment vehicle. A thing like a stock is an investment vehicle. You can go out and you can buy an individual stock, right? You guys know that. Another thing you can buy, I'm going to scroll down and I'm going to show you, in addition to a stock, you can buy a bond. They're very different, but they're individual assets that are based typically on one company. A stock, you buy a stock in a company. And if you want to understand what a stock is and how it works, I gave you lots of information. But I'm not trying to teach you about all different types of stocks. I just want you to know what a stock is. It's an investment vehicle. If you are an investor and you set up an account at a brokerage, like, what's a brokerage? When I say brokerage, what do you think? Schwab is a brokerage. That's where I do my business. You see Schwab right there. So Schwab is a broker. It's actually a custodian, but they're the ones that broker your trades. TD Ameritrade, Fidelity, E-Trade, Robinhood. I think, is it Robinhood? Yeah. So those are all places you could go and buy an individual stock or a bond. But so, that's where you trade. And trading and investing is kind of the same thing. but with very important differences. You're not going to be an expert on the difference between investing and trading, but you got to know that when you invest, you're basically making a trade. You're buying something and someone else is selling it to you. And so when we talk about investing, you got to understand that prices go up and down. So whether you're buying a stock, a bond, and here's some other, there's 5 investment vehicles I just want to highlight. So we talked about stocks, buying individual stocks, and we talked about bonds, and now I want to just highlight a mutual fund. So a mutual fund is an investment vehicle, right? You could say it's an investment. You would be right. Like, I invest in this specific mutual fund. But I want you to be smart enough to understand that a mutual fund is an investment vehicle. And inside of that vehicle, there is a couple of things. Like, we talked about stocks, we talked about bonds, and a mutual fund is an assembly of stocks or bonds. So if you buy a mutual fund, which is an investment, but it's also an investment vehicle, it's very different than a stock. Because if you buy one stock, like let's say you buy Apple, good call. If you bought Apple at the right time and you kept it, you made a lot of money. But if you bought Apple at the wrong time and your time horizon, you needed the money and you invested $100,000 and then you needed the money for a wedding or to buy a car or whatever, and you had to sell your Apple stock, you could find that maybe you invested when the stock was at the highest price ever, and then we had something happen and that stock price, even for Apple, dropped a lot. So for you, in a time horizon, you're not investing $100,000 back in 2009 when Apple stock was pretty low. It was $125 a share. And today it's like $150 a share. But it's done a reverse split, or it's done a split, not a reverse split. It's done a split like 3 times, like 10 to 1. So a stock that was worth 125 goes up to 1,000. They do a split. Now it's only worth 100. But instead of having 1 share, you have 10 shares. But still, my point is there's a difference between buying a stock and a mutual fund. A mutual fund has a manager who buys the stocks for you, and you pay the mutual fund manager a fee. So you could pick your own stocks and buy them and not pay the fee, or you could use a different investment vehicle that's designed to give you diversification. We're going to talk about diversification in a minute, but it's key to understand that the reason a mutual fund was invented was primarily to give you a couple of things. One, diversification. You buy one mutual fund and you get a whole bunch of stocks or bonds in that mutual fund. You may get stocks and bonds depending on what that mutual fund is designed to do. So I just want you to understand a mutual fund is a type, an investment vehicle. It's different than a stock. It's different than a bond. Now I'm going to share 2 more investment vehicles with you because I want you to understand all 5. I don't think this is on the quiz this time, but it will be on the quiz. So after mutual fund, and there are lots of rules about mutual funds, and this is my picture for diversification. It's an elevator. So imagine, and this is by my friend Taylor Springle. Taylor, if you're out there watching on Facebook or the YouTube, I love your illustrations. They're in all my books. And this one is the one that a friend of mine, when I started managing investments for people, I had a buddy who worked for Edward Jones, and he taught me a lot. He was like my mentor. And so, I wanted to know how he explained these strategies to people, these different principles. So he sat down and he said, here's an elevator. And he actually drew it on a napkin. He said, here's an elevator. And if you buy an individual stock, and let's say that you walk into an old building and you get on an elevator, would you want to be on an elevator with one cable? Because what happens if that company stock, the management, what if the really smart manager dies and then they hire some rookie dude or girl, or you know what I'm saying. The company, for whatever reason, takes a turn. That company stock is going to go down if management gets weak, or if they get competition that comes in and is better than they are. Lots of things can make a stock go bad. So the other elevator is a mutual fund, and it's got a manager, and the manager's job is to check all of those cables and make sure they're the best possible cables that could be on that elevator. And one of them may go bad, one of them may break, but with all of those cables on that elevator, you're protected. That's diversification, okay? And that's those two things, diversification, having more than one cable in your investment, and having a professional who's inspecting those cables or those stocks. That's what you get with a mutual fund. So at that point, let me ask you this. Does a mutual fund sound like a good thing to you? Yeah? Why? Yeah, you don't have your eggs all in one basket. That's a really good one. What else? Any other reasons you like a mutual fund? Besides what you just said, not having all your eggs in one basket is diversification. Do you like the idea of having a professional manage those investments for you?
If they're smart, yeah.
Yeah, if they're smart. Yeah, so that's a mutual fund. That's so far out of the 5 investment vehicles, we've talked about 3: a stock, a bond, and a mutual fund. So those are investment vehicles. But inside of a mutual fund, remember, there are other assets like stocks and bonds. So you really get down to stocks and bonds. That's the core. That's what makes up an investment. This is basically a stock or a bond. So there's tons of information. Again, this is posted in Money Study Group. If you want to understand what types of mutual funds, how they work. This is from Investopedia. They do a great job of providing good educational information. This is by Julie. This image, I guess, is by Julie. Anyway, let me scroll down, and I want to take us to the next investment vehicle. And again, there's tons of, you see there's tons of information here. I'm just scrolling, and this is in Money Study Group. I posted it so you could have it to review whenever you want, whenever you need. You do not have to. Don't be overwhelmed. I don't want you to think you have to learn this. But if you want to learn it, I want to make sure I do my job to make it available, because there are some students in this course who really want to become good investors. And if you want to be an investor, you should learn a lot more than I'm going to teach you in this course. But if you don't want to be a great investor, just like when we did bargaining and negotiating, remember, we've split up the room, and half of us, like, we love it, we want to do it, it's life to us, it's like a sport. And the other half is like, I don't really like it, but my goal was to teach everybody to know that there are a few basic things that all of us can do. Even if you don't love doing it, it could make a big difference in your bottom line. And so that's what I want to do with investing. I'm not trying to get you to become a day trader. I hope you don't become a trader at all, because your life is way too precious to spend looking at screens. I have to do that as part of my job, and I don't really love it. I'm kind of good at it, but it's not fun. It takes time. You don't have to do that. If you know these 4 investment strategies, you'll see that they work really, really well. But you need to understand investment vehicles, and the next one is called an index fund. An index fund is a little different than a mutual fund because it doesn't have a manager. Okay, so remember I told you the mutual fund, you pay a fee to have a manager, but an index fund works off of an index. What is an index? Does anybody know what an index is? So have you heard of the S&P 500, the Standard & Poor's 500?
Or 500 companies?
Yeah, that's the S&P 500. And one of these... ETF. So the ETF that I talked about earlier in the course is the SPY. And it is an investment vehicle, which we're going to talk about in a minute. It's not an index fund. It is an ETF, an exchange traded fund. So let me just talk about an exchange traded fund real quick. Let me go back to the 5 investment types. So the index fund it trades just like a mutual fund. And then you probably don't need to know this or probably don't care, but I want to just make sure I say it. An index fund is like a mutual fund. It's not a stock. It gives you diversification just like a mutual fund. But when I talk about the S&P 500, that's the 500 largest companies in the world, and that happens to be one of the 3 major indexes. So when we say index fund, we're talking about indexes, and one of the indexes is the S&P 500. In fact, if I were you, I would think first, when I think about an index, I would only think about one, maybe 2. The NASDAQ is the tech stocks. So there are 3 major indexes. The Dow, it's only 30 companies, 30 of the largest industrial companies. It's not worth watching because it's only got 30 companies. It's just really not. But the news people, they talk about it all the time. The one that really matters that you should, if you're going to think index, is the S&P 500 because it's the 500 largest companies in the United States, which turns out to be the largest 500 companies in the world. And so what that index does really sets the tone for all the other markets, all the other indexes. But an index fund, all you need to know is if you wanted to invest in the S&P 500, you would get an S&P 500 index fund. You would not have to pay a fee. You'd have a little fee. All investments have some kind of fees, but you're not paying for advertising and marketing. You're not paying for that special person who's may or may not be smart enough to pick the right stocks. So this is an improvement. An index fund is an improvement on a mutual fund because you get the diversification, but what don't you get?
Someone in charge? Or the fee?
The fee, yeah, the fee. The fees can kill you. And the mutual fund managers over time, if you review the studies, you'll see that generally over time, the managers do not outperform the index. Yet, because you're paying an extra fee for them to manage your investment, you may underperform the index by a good deal. So that's one of the things I wanted to just highlight is that these different investment vehicles, I just want you to know what they are. I want you to understand that there's a difference between a stock and a bond. There's a difference between a mutual fund and an index fund. And then finally, the last investment vehicle I'm going to mention is an exchange traded fund. It's an ETF. And if you're in my business, if you're an investment advisor, if you're an investment manager, if you're an investor, you really want to know about an ETF. Because just like the index fund was better than the mutual fund, the ETF is better than the index fund. So with a mutual fund, you get diversification. That's really, really good. But you have to pay a manager to pick and choose, which isn't always great. But sometimes a mutual fund is the best choice. And sometimes, like in your 401k, it may be your only choice. They may not have index funds. It depends on how the company set up that fund. So you need to understand the difference between a mutual fund and an index fund. And here's another big difference, and this is the reason that professionals like myself really love ETFs, exchange traded funds, more than mutual funds for sure, and more than index funds. And it's because with an ETF, like remember the SPY, my favorite investment. If I could only invest in one investment in my life, it would be SPY. Because what happens when I buy one share of SPY? What am I getting? SPY, remember, it's the S&P 500 ETF. It's the first one ever invented. It's hugely traded. But what am I getting when I buy one share of SPY?
All these 500 companies.
Yeah, not almost. I'm getting all 500 companies instantly with one purchase of one security. So it's like buying a mutual fund in that way. It's like buying an index fund in that way. The difference is I pay hardly no fees. The SPY, the management fee on that is like 10 basis points or maybe 8 basis points. And it has a dividend of almost 2%. SPY is a great, if you want to invest in the market, that's the investment I would recommend you invest in, is the SPY. Incredibly low expenses, pretty good dividend, which means they pay you every quarter of dividend. And it's hugely liquid, which means no matter what day it is, it can trade. And here's the big distinction if you want to know a little bit of investment guru stuff. Okay, the reason that we like the ETF better than the mutual fund, better than the index fund, is because an ETF trades like a stock. What does that mean? It means you can buy it and sell it instantly. With a mutual fund as well as an index fund, when you buy one, you put your order in anytime you want during the day, but your order gets placed at the very end of the day. So let's say that you wanted to buy an index fund, and it just so happens that on that particular day, the market in the morning was down 10%, say 7%. Like the day that that Russia invaded Ukraine, if you look at the chart, I'll show you a chart real quick of the S&P 500. If you look at this chart, you'll see the day that Russia invaded Ukraine. Can anybody see? You may not be able to. Let me just show you. I'm going to take a screenshot. I'm going to open that up, and I'm going to open it to this chart. So that is a daily chart, a one-year daily chart of the SPY. This is actually the SPY. And so you see it goes up and it goes down, right? Today, that's where it is right there. That's today. It looks like it's trying to decide if it wants to go up or down, because look at all those days that it's gone up, 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 up. So if you would have bought the SPY on this day right here, that's the day that Russia invaded Ukraine. And if you decided, okay, I had $100,000 and I've been wanting to put it to work in the market because it's just sitting in cash. Inflation's going crazy. I need to get some growth out of my money. And because you took this course, you know that the best way to invest in the market is to invest in the S&P 500. And the best way to invest in the S&P 500 is to buy some SPY. And so you buy SPY and you decide you're watching and you're paying attention and you know that the market has gone down, down, down. And that's the best time to buy, after the market goes down, down, down. So you just decide that on this day, you're going to buy because you're paying attention and you see the SPY goes all the way down to $410 a share. And you say, okay, I'm going to buy it. Maybe you have $10,000, maybe you have $1,000, maybe you have $410, but you buy a share of the SPY in the morning. And by the end of the day, it's up to $430. You made what? $20 on one share. If you did 100,000, that's even more. And then let's say you kept it and you kept it. But here's what I wanted to point out. That's what I just said is you buy the SPY. In fact, the thing about the SPY is in an ETF or a stock, like you heard of day traders, right? Like a day trader might have bought that in the morning and sold it in the afternoon and made that amount of money just in one day. And again, I do not want to encourage you to be a day trader because you'll go crazy. I've done it before. I know a lot of people do it and it's not fun. But here's what I want you to understand. The difference between the ETF, the index fund, and the mutual fund. The ETF trades like a stock. So if you bought it in the morning, you could sell it in the afternoon. But what happens if you decided to buy this mutual fund? Let's pretend this is a chart for a mutual fund, and you put your order in at 9 o'clock in the morning, right there. What price are you going to get for that mutual fund? Are you going to get that discounted price while the market was way down? Well, you're going to pay the fee no matter what. But the point is, if you buy a mutual fund or an index fund, when you put that order in the morning, it goes into the end of the day. So that means you're getting the higher price, which means, oh, you didn't make any money from that investment because you were really smart and you waited until it, and you will never know when it hits the bottom. My point is just to help you understand why investment managers, professional money managers, an ETF is so much superior to an ETF, to an index fund or a mutual fund. And that's one of the reasons why. There are other benefits like taxes and so on. So let me go back and just see what is the silly thing doing today. The market is doing pretty good. SPY is up $3 and it's up 72 basis points today. See, Tesla's going up, Amazon's going up. Okay, that's enough. We don't need to be looking at the market while we're teaching the class. So that is an ETF. So those are the five. Investment vehicles I wanted you to understand. What are they? Repeat them back to me.
Stocks, bonds, mutual funds, ETF, and index.
Yeah, and I would think of them in this way: stocks, bonds. Those are very different. They're individual. Usually you buy a bond because a company issues the bond. So it's got some risk. If the company goes out of business, you may not get all your money back. Just like if you buy a stock from a company, if the company goes out of business, you're going to get your money back if you buy the bond sooner than if you bought the stock. So stocks, bonds, and then a mutual fund, which gives you what two things that are really what makes it a mutual fund? Diversification.
A fee, and someone's in charge of them.
Yeah, so that's three things. The fee is actually what you pay to have someone in charge of it. So you have a professional manager picking and choosing the stocks in a mutual fund, and that's what you get. You pay a fee for that, but you get diversification and professional management. And what about the next one? The next one is what? Index fund. What do you get from an index fund? Diversification without a manager. Do you think the fees are less or more in an index fund than they are in a mutual fund? Less. And then what's the final investment vehicle that I love with all my heart? ETF. It's got even lower fees than an index fund, but it gives you the same diversification. And again, the one that I use all the time is the SPY, because that is, if you want to invest in the market, that's the way to do it. So I posted an article called The Market, and I wanted to just kind of, before we get into the 4 investment strategies, and I know I'm going to have to go fast here, but when I say the market, when you hear someone say the market, what do you think?
Like the current economy?
The current economy. So, there's so many different definitions for the market. I just want to set one down and say that when we say the market, let's all agree, at least for the sake of this course, that when we say the market, we're talking about the stock market. And when we're talking about the stock market and we say the market, we could be talking about all of the indexes combined. We could be talking about the bond market. All of those things are part of the market, okay? But what I want us to think about is the single most focused on index on the planet, hands down, bar none, is what? What do you think the most important index is, if there was one?
The Dow or
The Dow has 30 stocks in it. So the SPY, the Standard and Poor's, in my opinion, and this is not just my opinion, it's the opinion of a whole lot of people who do what I do, and a whole lot of people who are not professionals, but they're doing what I do because they're good at it, and that's how they make money, even though they don't do it professionally. A whole lot of people agree with what I'm about to tell you. That when I say the market, I'm really thinking about the Standard and Poor's 500, the S&P 500, or this individual holding called the SPY. So if you focus on just the Standard and Poor's 500, you're going to understand what's happening in the market. If you just followed the S&P 500, you'd be really close to the market. Okay, so it's just a definition that I would say if you're going to follow the market, the SPY is a good way to do it. And when I say follow the market, like I'm looking at this chart, I open the SPY, and I can almost tell you what's going to happen in the market if I can understand how this chart's going to work. Because you see it goes up and it goes down. The market, what does the market do? It goes up and it goes down. And when I say the market, what am I talking about? I'm talking about the stock market. And when I'm talking about the stock market, I'm typically thinking about the Standard and Poor's 500 because those 500 companies, they make up a huge part of the US economy. They make up a huge part of the world economy. And when those stocks go up and down in aggregate together, that's what the S&P 500 does. It's like it takes all of those together, and when they go down or they go up, it's kind of an indicator. And if you're an investor and you're trying to make money trading stocks, this is a good way to do it because this is a way more predictable, high probability way to invest than if you're just picking a bunch of little stocks trying to figure out if it's going to go up or down. Does that make sense? So that's what I want you just to understand is when I talk about the market, it's like this is the chart that I would say we'd be looking at is the S&P 500, or the way you buy the S&P 500 is to buy the SPY. You could do the same thing for the NASDAQ or the Dow. There's an ETF for those as well, and that's all in your notes. But does that make sense? So when I look at this chart, again, if you understand how technical analysis works, you would know that today looks like a day that could be where maybe we're going to look at all those days that the market went up, 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 up. Does the market always go up and just up? What does the market do? Up and down. It's important for you to understand that the market goes up and down. Do you think the market after today, if you had to bet $1, just knowing what you know already, would you bet that the next 3 days will be up, down, or sideways? Down? Okay, so it's either going to go up, down, or sideways. That's what the market does. The market is what? The stock market. And when I say stock market, what am I talking about? The S&P 500. Because if you look at the market, up here at the top, you see those 3 indexes. So those 3, whoops, what did I do? So can you see up to the left? Oh, you can't see it because my head's in the way. So let me open this up and just bring that down. Can't really see it because my head's in the way. But you see the NASDAQ there and the S&P 500. And typically when one goes up, when the S&P 500 goes up, you can kind of assume that the others are going to go up. Okay? So that's kind of how the market works. So I did post an article called The Market because I wanted you guys to be on the same page that I'm on when I talk about the market. Okay, so now let's jump into investment strategies. I thought I had, I don't. I thought I had an article. I posted an article on asset classes. So, in fact, I think I do have it. Let me see. I'm not seeing it. Give me a second. I guess I didn't. I thought I did. So I posted. If I didn't, I will. I will post an article called Asset Classes, because asset classes is another thing you need to understand, and it is on your quiz. Because asset classes are really simple, they're easy to understand, but we talked about stocks and we talked about bonds, right? Well, those are two asset classes because a stock and a bond are different. So we could say that's two asset classes. But if you were looking at a stock and you said, okay, there's a whole bunch of different kinds of stock, and each of those kinds of stock would be different asset classes, what would you think I'm talking about? We said the S&P 500, are those big companies, small companies, or medium?
Big.
They're big companies, so they would be called large cap. In fact, they would be called US large cap. That's an asset class. It's a real thing. So I want you to know that's an asset class. You need to understand that. And then what else do you think we have? If we got large cap, what other kind of cap might we have?
Medium and low.
Medium and small. And those are asset classes. And what about stocks that are not in the US, but they're in China? What would they be called? Foreign or international, or even you could get specific and say China, you could call China its own asset class because it's not real transparent, and I don't want to get in trouble because they're probably watching me. But yeah, so asset classes are very different. And so when we talk about asset allocation, we need to understand asset classes. And same with bonds. So we say bonds, and you have all of this in Money Study Group. But when we say bonds, if that's an asset class, what do you think are some sub-asset classes inside of bonds?
Like government bonds?
Yeah, government bonds, U.S. corporate bonds, municipal bonds, international bonds. Government bonds could be U.S. government. We call them sovereign bonds. But it could also be China's sovereign bond, or Japan, or Great Britain, England. What do they call it these days? England? UK, yeah. Yeah, or Belgium bonds, or Italy bonds. Any country can issue bonds. Those would be called government bonds, but they're not U.S. government bonds. That's a special asset class. Very safe. The safest asset class on the planet probably is the U.S. government bond. Not a corporate bond, but if Apple is the one issuing the bond, do you think it's pretty safe? They have like $3 trillion in cash, maybe 10 trillion. I don't even know. They have a lot in cash. And so they issue a bond and they pay you interest. You invest, you buy their bond, they pay you interest. That's a bond. That's how that works. Do you think it's safe if it's with Apple? It's very safe if it's with Apple. And that's why they're only paying you a tiny, tiny little bit of interest, because it's very safe. That's another thing you need to understand about investing, is that if you take risk, if you have a good opportunity for a lot of growth, you have more risk. That's why the S&P 500 is probably pretty risky. And I'm going to tell you a story now to help you understand diversification. Do you guys ever hear of Enron? What do you know about Enron?
The biggest fraud or something about fraud. And I think they were doing really good.
Yeah. They were doing really good, but they were cooking their books from pretty early on. They just kept getting bigger and better and making more money and making more money. And I think they, somewhere along the line, decided that they couldn't not do that. They had to make, and they started lying and cheating and who knows who knew what. But during Enron, I had a couple of clients. And so diversification, this story about Enron is really about diversification. So I had one client, her name was Andrea, and she was really smart. She worked at Enron, and I was her advisor. And so I wanted to make sure she was not, I knew Enron stock was going through the roof. If you work for Enron and you're putting your money in your 401k, just like it's Shell, they're going to give you the opportunity to put all of your 401k in what? in your own company stock. And so I always tell people don't put all your money in your company stock because that's just bad. It's not diversified. If you're working for Shell or Enron or ExxonMobil, it doesn't matter who you're working for. You're getting your paycheck from them. So you don't also want to have all of your retirement funds with them. That's not diversification. It's having all of your eggs in one basket. And so that was my conversation with Andrea is let's not do that. And she was smart and she's like, yeah, let's not do that. So while Enron stock was still way up here, she diversified and she put it in some different baskets, okay? But then this other guy, Bill, he was pretty high up at Enron. He had way more than $1 million in his 401k. After the fit hit the shan, after stuff started happening, after Enron started to really look weird, the company, the leaders at Enron were telling the employees, look, there's never, ever been a better time to buy. It's kind of like, let me show you this chart real quick. If you're me and you're sitting here wondering, okay, when is this chart going to give me an opportunity to buy more? Because I like this. I think this is going to go up and up and up over time. 10 years from now, I think it's going to be a lot higher. But I don't want to get into it up there if it drops way back down to down there, right? I'm like, but when Enron stock was way down there, the leaders at Enron were saying to the employees at Enron, there's never been a better time to buy. Hello, where'd I go? Can you imagine? And so Bill, this other client, he put all of his money in his 401k, took out a home equity loan, bought Enron stock. He was convinced because the leaders were lying that this is the best opportunity because he knew, he remembered, he saw his 401k had gone through the roof. He had a pile of money because of Enron stock. And then Enron stock turned into like a penny a share. He lost everything. He got really stressed. He was old enough to retire. He was just waiting for the right time to retire because he liked making money. He was making a lot of money. And he lost his income because Enron went out of business. He lost all of his 401k, and he still had a loan on his home. And then he died of a heart attack that was stress related. So that's my story about diversification, and it's hugely important. It's one of the strategies that I want you to understand is diversification. It's a very simple strategy, but it's really important. So that's Enron and diversification. Now let's talk about asset allocation. So we talked about different asset classes. So, right, we've got stocks, bonds, real estate, that's an asset class. Commodities, like, do you know what a commodity is? Gold is a commodity. What else? Something that's gone up, up, up lately.
Oil?
Yeah, oil. It's actually going down, down, down now. I could show you a chart. Did you have a question? No? No question? So asset allocation is all about asset classes, okay? Am I hearing a question? Hello? No question. You're muted, Mr. Tron, if that's, or I'm not sure who that is. Okay, if you want to ask a question, unmute yourself and I'll be happy to answer it. So asset allocation, again, is the single most important determinant of your portfolio's returns. In other words, if there's one thing that's going to make your money grow the most, it's this. It's asset allocation. That's why it's important for you to understand different asset classes so that as you get into investing, even in your 401k, you want to be able to pick different asset classes because what happens is the market goes up and the market goes down. And when I say the market, what am I thinking? Stock market, and mostly the S&P 500. But that honestly is just one asset class. So there are some other asset classes I should have in my, if you were my client, when I build a portfolio, I don't just put everything in the S&P 500. It is the sweetener, okay? It's like what I add to the portfolio when I think we're going to see some upside. So on a day like the day that invaded we Russia invaded Ukraine, when the market does something like that, that's the best time to add a little risk to your portfolio. And so the SPY, the market, if you want to add the market, that's the way to do it. But your portfolio, your asset allocation should be a mix of different things. You shouldn't just have the SPY, you should have some bonds. You should have some small companies, because what's a small company? What is the risk if a do you think the large companies have a lot of risk? You think they do? You think the S&P 500 is, in terms of an asset class, is a lot of risk? Why? Why do you say no?
They're settled already.
Because they're settled, they're big, they're established, they're huge. So they don't have near as much risk as a small company would have. Now, the other side of that coin, though, risk and reward. Do you think the large cap stocks, the S&P 500, do you think those investments are going to give you the greatest return on your investment? Or would a small company that's just getting started with a really good idea and the price is really low, but they're just getting started, we know that company has more risk, right? But if it turns out to be another Apple or another Tesla or another Amazon, because they all started out tiny, Google started out tiny. So if you invest in one of these small companies, your opportunity for growth before it turns into one of the S&P 500 companies could be huge. And that's why asset allocation is the single most important determinant of your portfolio's returns, because you don't just want to have one asset class. You never know which asset class is going to go up or down. And one of the things you need to understand is that different asset classes do different things. So bonds typically go down when the market goes up. And when I say the market, what am I talking about? Stock market. And when I say the stock market, what am I thinking? SPY, S&P 500. But I also know the NASDAQ, those tech stocks, they can jump up really high. In fact, I don't want to miss that asset class. So I would not just be investing in the SPY. I would also have this one right here that's called the Qs, which is really an ETF just like SPY, except this one is for the NASDAQ. So Apple, Microsoft, Google, Amazon. That's what this would be. But again, look at that chart and tell me, what would you think if you had to bet $1? Is this investment going to go up, down, or sideways over the next couple of days after that many days going straight up? If you had to bet $1, hopefully you'd bet $1 it's going to go down. You could be wrong. It could go way up. It could hit all-time highs. But my bet would be after that many days going up, if you had to bet $1, you'd be like, I'm shorting that. I'm not going to short it because you can lose all your money when you short a stock. But you could trade this just like the SPY. This is a different asset class. This is tech stocks, okay? They could be really big companies, but they're in a different sector. The S&P 500 is just the S&P 500, and it includes a lot of the same stocks that are in this one, okay? But that would be... let's see. I was going to show you another chart, but I don't really need. So this is the bonds. So the bonds, the market's been going up. What's the bonds been doing? Down. So if you had to bet $1 on this chart, this is not the S&P 500, but when we say the market, should probably think about bonds. This is a bond chart. If you had to bet $1, is this going to go up or down or sideways? You don't like that chart, do you?
No.
No. But that's a better chart to buy sometimes when you know it's going to go up. You never know it's going to go up. But if I told you that generally when the market goes down, the bonds, because the bonds, remember, what's the most secure investment on the planet?
Bonds.
What kind of bonds are the most secure investment on the planet? U.S. government bonds, and that's what this ETF is. It's U.S. government long bonds. So if the market goes down, people want to get out of risky assets and they want to go into safe assets, and that's what makes the price go up. And if that's true, and you bet your dollar that the market was going to go down, what would you think this one would have to do, or would be most likely to do? Yeah, yeah, exactly. If you can understand that, what I just said, then you can understand why asset allocation is so important. You see bonds there, you see real estate, you see commodities, and just know that these asset classes go up and they go down. They're always going up and they're always going down. And when the market goes up, other things go down. And that's why asset allocation is the single most important determinant of your portfolio's returns. In terms of an investment strategy, it's probably the most important. So that's asset allocation. Now I want to talk to you about dollar cost averaging. I told you earlier, this is the most powerful investment strategy for younger people, because over time, this one is going to give you the best opportunity to grow wealth. So right here, what we have is Farmer Joe's chart, and it's got all my notes. I think I have it down here somewhere without the notes. I don't. Bummer. I thought I had the clean chart, but you're going to have to, these are my notes. Let me walk you through dollar cost averaging. So Joe's a client of mine. Okay, he's a farmer, Farmer Joe. That's Farmer Joe's charts. Joe did not have cows, and he had some money, and he wanted to make some investment, and he wanted to diversify his farm. So one of the ways you diversify is you can add a product, right? You can add another revenue stream to your business, and that's what we wanted to do for Joe. Cows in Texas are not a bad idea for a farmer, because you have beef, you have milk, you have leather, you got a lot of stuff that comes from cows. And so Joe decided, okay, let's start buying cows. This was like a new asset class, right? And so Joe and I talk about how we're going to do this, and we decided we would use dollar cost averaging. And here's how it works. So Joe decided, and I helped him because I was his advisor, that we would put $100 a month into this investment. So every month, $100. So that month that we started, cows just happened to be $100 ahead. The next month comes around, and Joe's going to put how much into this investment? $100. But cows happen to be only $50 ahead. How many cows does Joe get the second month? 2. First month, how many did he get? Just 1. He's like, hey, cows are $100 ahead. They're probably going to go to $200 ahead. I'm going to buy one because I'm doing $100 a month, dollar cost averaging. The third month comes along and cows go down. They cut in half again. So now how much are cows? They were $100. They fell down to $50. How much are they now? How many does he get? He can get $25 ahead. How much is he putting in each month? 100. See, this is how dollar cost averaging works. You create a systematic plan to invest so much money, and then whatever the asset costs, you're buying more or less of it depending on the value or the price. In this case, it's cows, and the price dropped from 100 to 50 and then down to $25. And so how many cows did he get? 4. Yeah, so that's month number 3. Month number 4 comes along, and cows drop all the way to $20 a head. How much is he putting in? $100. How many cows does he get?
5.
That's when Joe called me. He said, Munchback, you've got me buying cows. It's the stupidest thing I ever did in my life. I want to sell all my cows and get out of the cow business. What do you think I said?
No.
I'm like, dude, Joe, come on. You just bought a new Deere tractor? I'd sell the tractor and buy more cows. Because the tractor still has, it's like trading it because of the supply chain thing and whatnot. You can sell that tractor for higher than you could ever sell a used tractor in history. Sell the tractor, buy more cows. What do you think Joe said?
You're crazy.
Yeah, you're crazy, but I'm like, dude, you're paying me money to give you advice. You can either fire me or you can take my advice. It's up to you. But that's my advice. You do not sell your cows. You needed cows. You wanted cows. Cows are part of your overall strategy. Buy more cows. He's like, okay, I'll buy the 5 cows. So he gets 5 cows that month. The next month comes and cows start to creep back up. They're now back to $25 a head. How many cows can he get? 4. Yeah, gets 4 cows. He's feeling a little better because he bought 5 last month. At least he's getting, and then the next month they go to $50 a head. How many can he get that month? 2, yes. And you get it. The next month they get to $100 a head. And how many does he get? 1. So how many months has Joe invested? 7 months. And how much per month did he invest? So total of $700. And then Joe calls me and he says, okay, Jim, cows are a little, I just can't take it. They go up and down too much. I want to do something else. I want to sell my cows. I'm like, okay, cool. They're at $100 a head. How much money did we make over the 7 months investing $100 a month using this strategy called dollar cost averaging? Because if you would have done it the way you wanted to do it, Joe, you would have taken all your money and you would have bought cows and you would have built your whole herd day one. And I'm like, don't do it that way, Joe. That's not smart. Let's do it this way. Let's use dollar cost averaging, which we did. So for 7 months, $100 a month, a total of $700. Now cows are back to where they started. How much would he get if he sells all of his cows?
Quite a bit. Some of them, when he got them at 25.
Is that my phone? Something's
Yeah,
buzzing.
it is. I see it.
Oh, it's still letting me stay on, I think. Good. Could you see who it was? It's not my wife.
I didn't see it.
Okay,
I
good.
just saw the,
All right.
the notification.
So back to the cow story. How many cows did Joe buy over 7 months? You can count them there, I hope. How many do you see? 1, 2, 3, 4, 5, 6. I know how many there are. Why am I counting them? Do you know? How many do you count? Can you not see them?
I think it's the
18?
18.
I think there's 19. 1, 2, yeah, 19. So back to the question. If Joe sells all of his cows today, they're $100 a head. How much is he going to have in the bank?
Quite a bit, because some of them go to profit.
Quite a bit is not an answer. It's a very simple answer. If he's got 19 cows,
Oh,
yeah. If he's got 19 cows and they're $100 a head.
Profit-wise.
Well, we'll talk about profit in just a second, but just the total amount that he has in the bank is $1,900. Now we talk about profit. If he's got $1,900, how much did he actually invest? $700. For 7 months, he put $100 a month in, but the value of those cows kept going down, and he kept doing the dollar cost averaging because he followed my strategy. It's not my strategy. It's a great strategy, especially when the market's going down, down, down. You don't have to be afraid of that. You just stick to your plan because over time, what's the value of cows going to be? It's going to be higher. What's the value of oil going to be over time? Higher. Wheat. What about the S&P 500? Over time, higher over time, absolutely. You guys have a lot of time to use this strategy, and I want you to use it especially when we have wicked, nasty market crashes. I want you to be fearless about sticking to your plan. You will be doing this in your 401k automatically. because your 401k, you're going to have your check deducted. Every paycheck is going into your 401k account, purchasing whatever it is you set up as your asset allocation. So you're going to be using this strategy automatically without even having to think about it. Go for it. Do that. Does that make sense? So Joe invests $100 a month for 7 months. That's $700. He ends up selling the cows for $100 a head. They never went over $100 a head, and he made $1,200 profit. That's how dollar cost averaging works. Now let me finish up. Any questions about that? Does it make sense?
So, if you're doing like this, and since you're only spending 100 a month, is it basically dollar cost averaging is not as risky?
Correct. The question was, so you're doing this $100 a month. Does it mean that investing is not as risky? Absolutely, that's what it means. Not only is it not as risky, but it's also incredibly more effective in terms of returns. So it's both. That's why all of these strategies help you maximize your return and minimize your risk. But I told you this one's the most powerful. Asset allocation is the most important determinant of your portfolio's returns. But when you combine good asset allocation with dollar cost averaging, you're getting much lower risk with a much greater opportunity for reward, especially when you have as much time to invest as you have. So I want you guys to be investing aggressively in a smart portfolio, including the market, which I consider to be the S&P 500, including the NASDAQ, all those tech stocks. I want you to be very diversified, and I want you to have a good mix of asset classes, which means good asset allocation. And yeah, this lowers your risk. Because if Joe would have taken that $1,200 or $700, which is how much he invested in cows, if he would have said, Jim, I got $700 to invest in cows, let me go ahead and buy cows all right now and I'll have all my cows. It's like, why wouldn't I want to have my cows now? Then I can start getting milk and leather and blah, blah, blah from my cows. I'm like, yeah, that's one way to look at it, Joe, but what if this happens? Because cows were $100 a head when he started. And the reason he wanted to buy cows is because they'd gone up so much and he felt like he missed out. I'm like, well, before you do that FOMO thing, you know what FOMO is? Fear of missing out. That's how a lot of people invest. They see the market go up, 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 and they got to get in. And do you know what that creates? That is exactly what creates the top of the market. And that's exactly what happens before it crashes. We call it dumb money. The dumb money comes rushing into the market at the very end of the rally, and that's when they lose, and they say, I'm never going to invest again. But then they watch the market go up, 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 and guess what they do? Then they invest. And then the market, because the market always goes up, and it always goes down, and if it's not going up or down, it's going sideways. But asset classes, they function differently. So that's asset allocation. Now I'm going to talk about portfolio rebalancing, and this one I'm going to do quickly because we're really out of time, I think. Are we out of time? We're pretty close, huh? You want to stay? You're going to stay anyway, Ashley. So portfolio rebalancing is pretty simple. I have a picture of a pie. And if you think about your portfolio, and if you've done what I suggested and you've applied good asset allocation, you know you have a percentage of each of these different asset classes in your portfolio, and including the S&P 500, the U.S. large cap stocks. So if you were looking at this right now, and let's just pretend that each of those pieces of pie was a different type of investment, a different asset class, maybe a commodity, maybe a bond, maybe a stock, maybe the S&P 500. Out of all those pieces of the pie, which one do you think is oil? The big blue one. That's oil. So oil should be, let's say that oil, you started out with your plan, you wanted oil to be 10% of your portfolio. But now it's grown to be way more than 10. It's more like 12 or 14 or 15. or 20. So what do you want to do? You want to rebalance your portfolio, which means you want to sell some of that oil while it's high and buy, what do you think that dark blue one right there, what do you think that might be? We looked at the chart. Bonds, yeah, it could be bonds because bonds have gotten crushed because interest rates started to go up. So if you're going to use good asset allocation, you're going to know that different asset classes go up and down, right? And so when it comes time every 6 months, every year, every quarter to rebalance your portfolio, you're selling the things that exploded up and you're buying some of the things that shrunk. And what is that like? What does that remind you of? Another strategy we talked about. I think of it like systematic dollar cost averaging over time. When you rebalance your portfolio, you're taking the growth and you're selling it off and you're buying low. Does that make sense? It's a strategy. Portfolio rebalancing. That's how it works. The reason it works is because you're selling off. Remember, always remember, the market goes up and the market goes down. Every asset class goes up and it goes down. And when the asset classes inside your portfolio go up, it makes these pieces of the pie get bigger. And when you want to, take some of that risk off, that's what you're doing. You're removing the risk because what happens after oil goes way up so fast? It's going to go down. So by rebalancing your portfolio, you're selling some of your profits and putting those profits into something that's already shrunk way down. Does that make sense? Do you see how that can make you grow wealth over time? 4 investment strategies, starting with the perfect investment. That's where you get to practice all of these 4 strategies that are designed to help you maximize returns and minimize risk. Diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. One more time. Diversification, asset allocation, dollar cost averaging, portfolio rebalancing. Diversification is the simplest, most common strategy, and it helps you prevent risk. Think of Enron. Asset allocation is the most important determinant of your portfolio's returns. It's really important. It involves asset classes. Dollar cost averaging, in my opinion, is the most powerful strategy you can use over time to build wealth. Remember Farmer Joe and the cows. And then portfolio rebalancing is just a way to take those profits, take the risk off, and invest them in other asset classes that have shrunk inside your portfolio. And over time, portfolio rebalancing will have the same impact as dollar cost averaging. Since you have a long time to invest, these 4 strategies, even in your 401k, will make you grow wealth over time. They're proven. They're absolutely going to work. I promise you, if you practice these 4 strategies, you will become a fearless investor. And by the time you get to be my age, you'll need some different strategies, and we'll talk about those later. Next week, we're going to talk more about investing. I'm going to highlight these strategies, and we're going to also talk about types of accounts, like a 401k, a Roth IRA, a traditional tax-deductible IRA. So any questions? I'm going to hang around. Otherwise, we're done.
I have a question.
Yes.
So let's say Farmer Joe came into the market when it was all the cows were on sale and he had 700. Would you tell him to?
I might. Honestly, I would look at the chart, the price of cows, and I'd think about why they're so low, and I might have said, yeah, let's buy them all.
Okay.
But that would be it would be risky. It would be risky, and it would feel hard to buy cows when they're giving them away. Why are they how? But yeah, so you may remember in 2020, oil was trading at a ridiculously low price because of COVID. And so I was telling all my clients, look, gas is $1.50 a gallon, $1.30 a gallon. Do you really think it's going to stay that low? No. And so I was buying oil company stocks like crazy. But today would be very different. If I looked at a chart for an oil company, I'd say, no, do not, if anything, sell it. cut back a little. Don't sell all of it, but yeah. So if I was smart and if Joe was going to buy cows and I could look and see historically what cows sold for and they were at all-time lows, I probably would have said, Joe, let's go ahead and take the whole 700 and buy cows. If I was really smart, that's probably what I would have done. But I'm not really smart. And I never know when the top or bottom is in. I just know for younger people, dollar cost averaging it's great. It really works. So, good question. Okay, I don't see any questions in the chat. I'm going to look one more time. Good comments in the chat. Sorry I didn't comment on your comments. Okay, we're going to wrap it up right there. I'm going to end this